Well, good morning, ladies and gentlemen. The numbers of attendees are still clicking up, but we're a minute or so past the start time, so I think we should probably kick off. We have a lot to get through. Welcome to the latest webinar in our series on private client and entrepreneurial business tax matters. Today's topic is the tax implications of cryptocurrencies, so pretty current. My name is Patrick King. A lot of you probably know that already, tax partner at MHA. And I'm joined today by Mohammed Desai, who is one of our cryptocurrency specialists, and Tony Dangel, who is head of tax at cryptocurrency software specialists Coinbee, and more about him a little later. We'll also be joined in the background today as usual, by James Kipping, who will take part in the question and answer section, which hopefully we'll have at the end, assuming we have enough time. So what will be covered? We can just go to the next slide, please, Mohammed. So what we're going to go through today is briefly what is cryptocurrency. I imagine most of the people on the call will know that, but not everyone does. So we'll briefly cover that. What is the HM Revenue and Customs view on cryptocurrency? What is deemed a disposal, which is going to be key for tax considerations? Will trading cryptocurrency be deemed trading or capital? So will it be income or capital gains? Very important point. What are the tax implications of actually mining cryptocurrencies? Roughly what that is. What are the tax implications of niche areas within cryptocurrency, such as staking, forking, and airdrops? Different varieties of those. And what Hmrc are currently or recently putting in place to try and ensure that the tax due on crypto is being collected. Just before I hand over to Mohammed, who's going to do most of the talking today, there's three things I think we'd like to achieve as a result of today's webinar. The first is just to provide you all with some information, which essentially boils down to crypto assets are taxable like anything else. Because we're getting the information that an awful lot of people still think that cryptocurrency somehow avoids taxation. Well, it sadly doesn't, and so hopefully you will pick up some information on that today. The second thing is we want to let you know that we can help. Well, we do have knowledge and specialists in this area. And the third thing, one of the fundamental problems with taxation and dealing with cryptocurrency is not so much what is and what is not taxable, although that's a matter of knowledge. But what is difficult is practical, in that there tend to be a vast number of transactions when people are buying and selling in cryptocurrency. It's very easy to do that on your platform, Coinbase or Binance or whichever ones you use. So I've come across people with hundreds and thousands of transactions which haven't been declared for 2 or 3 years potentially, and which will cost, as you might imagine, quite a lot in professional fees if we have to do that the old-fashioned way. And that's where we're hoping that our friends Coinbee may be able to help us or help you in making that practical side a little bit more straightforward. Okay, so that's probably enough from me. We've got a lot to cover as usual. And hopefully we will have some time for questions at the end. And so what I'm going to do now is hand you over to Mohammed, who will take you through a bit more detail on the tax side.
Thanks, Patrick. Hi, everyone. Just be going through, as Patrick has mentioned, the tax implications of cryptocurrency and of the areas which are very important to be knowledgeable on, just in case you do deal in cryptocurrency, or if you do have, for any accountants listening, any clients who deal in cryptocurrency. So I think a good place to always get started is sort of what is cryptocurrency. So cryptocurrency is a decentralized digital asset used as an exchange, which uses cryptography as a means of security. And it tends to operate without sort of the backing of any central authority, such as banks or the government. So you couldn't go into a bank and say, I want Bitcoin or Ethereum, for example, and sort of it's not governed by any governments, the US government, the UK government, any other governments as well. Obviously, you might have heard in the news recently that some governments are trying to block it as best as they can, which may cause changes in price. But as a general, it's not governed by any governments. And instead, it's actually underpinned by blockchain technology. Now, you might be wondering, what is blockchain technology? It really is a decentralized ledger of all transactions across sort of a person-to-person network or sort of a software-to-software network as well. So using the blockchain technology, participants can confirm transactions without a need for a central clearing authority. Now, those first 3 points are quite a detailed description of what cryptocurrency is. So you might be thinking, in simple terms, what does that mean to me? To put it simply, cryptocurrency is a digital currency which uses codes as a means of security, and it isn't backed by any banks or governments. And the blockchain is essentially a digital database in a way, containing data keeping records of all transactions carried out. So any cryptocurrency transactions carried out are all detailed on the blockchain. Cryptocurrency now can be traded on specific exchanges such as Coinbase, Huobi, eToro, Binance. There are many others out there as well, both UK exchanges and US, Japanese, Chinese exchanges. There are a number of exchanges which can be traded on. And now, because of how common cryptocurrency is becoming, it can be traded through most mainstream banks and online payment platforms such as PayPal as well. A few years ago, sort of around 2017, when Bitcoin's value did start increasing significantly, there were very few exchanges to actually trade on, and Coinbase was the main one that you had to sort of go through initially to start trading Bitcoin and Ethereum, which were the main coins at the time. But sort of as cryptocurrency has become more commonly traded and more coins, a lot more coins have started to be traded, more exchanges have been created to trade on. And mainstream banks have now adapted to allow users to trade through them, although I would maybe not recommend it, as the commission rates tend to be very high. Not that's any investment advice from me. The most common cryptocurrencies can include Bitcoin, Ethereum, Ripple, Dogecoin's one that you might have heard of via Mr. Elon Musk, but there are a number of other coins out there as well. So there are hundreds, if not thousands, of coins that could be traded on any platforms. Now, just some statistics on screen from a survey carried out by the Financial Conduct Authority towards the back end of 2021 in terms of the ownership of individuals in the UK, how many people own cryptocurrency, what people see as and sort of the most common ownership age as well. So based on the summary and survey carried out by the FCA, it's estimating that just under 5% of the UK's total population actually owns cryptocurrency. That percentage is around 4.4%, they estimate, but the awareness of cryptocurrency has significantly increased from the year before. It's gone up 5% from the year before, they estimate from around 73% to 78%. But surprisingly, the understanding of cryptocurrency has actually decreased. So this is good why it's always good to do a webinar, just to sort of help people understand what cryptocurrency actually is and sort of the tax implications of it too. You can see there that there's a significant increase in the amount of people that have invested in cryptocurrency in the previous 12 months, mainly due to investments during lockdown. People, because they had a lot of their time on their hands during lockdown, they tend to sort of have a look into it, maybe try and understand it more and see it as an investment opportunity. The most common ownership age is actually male over 35-year-olds. There is not too much of a difference between 18 to 34-year-olds and over 35-year-olds, but per their survey, the most common ownership age is over 35. And it is quite understandable that most people are seeing it now as an investment opportunity. Maybe in the past they saw it as a gamble, and it wasn't an investment that could be held for the long term, and it would be more of a short-term investment, or it is just a gamble and it's essentially a fad and it's going to disappear very soon. But it doesn't seem to be that way anymore. It seems to be here to stay, and a lot more people are seeing it that way. And it's worth pointing out, though, in these survey that has been carried out, that the sample sizes tend to be quite small. So as figures progress, and as obviously the 2022 survey is carried out, and as sample sizes increase, we will see we'll have a better idea of the number of people who actually invest in cryptocurrency, and the sort of attitude towards cryptocurrency as as the more it comes in the news, it might influence people's decisions one way or the other. More people might seem to understand it and look to invest in it, whereas some people with maybe negative media gets or with things that they see in the news may see it again just as a fad and won't be interested in investing. But with the more common, with the more recent surveys, I guess we'll be able to find that out. Now, a good point to start is, from a tax perspective, how do Hmrc view cryptocurrency? So unlike other countries where there is maybe a separate cryptocurrency tax which has been introduced, there is no actual specific tax for cryptocurrency in the UK, and they will be either subject to income tax or capital gain tax, depending on the activity carried out. They are essentially deemed by Hmrc to be assets, and the tax implications of them are deemed very similar to very similar to share trading, and sort of the rules associated with share trading, in terms of the trading element, with what is going to be deemed as trading, what is going to be deemed as capital gains. And although I mentioned earlier that it is a form of digital currency, as it is not physical currency, sort of your Bitcoin, your Ethereum, you can't physically hold it. Hmrc don't deem them to be currency. So in their eyes, they do seem cryptocurrency to be assets and held as assets, or sort of shares in a way, very similar to shares. Individuals who hold crypto, Hmrc view them as holding personal investments, either for capital appreciation or more recently to make particular purchases, such as maybe non-fungible tokens, which can be purchased via cryptocurrency, or more recently as well, Tesla have sort of introduced it that you can purchase their cars via cryptocurrency, and there are it's more common in America, but it's becoming more common over here as well, where you can purchase goods via cryptocurrency. And although it can be deemed sort of a gamble, Hmrc don't deem buying and selling crypto to be a gamble. So unfortunately for us, it won't be exempt from tax, as I'm sure most of us wish it would be. So any proceeds received from sale or any cryptocurrency received via other methods will be taxable in the UK. So another question is, when income is received from trading cryptocurrency, is it deemed to be trading income and liable to income tax and national insurance, or is income received on sale of a cryptocurrency deemed to be capital and be subject to the capital gains tax? As with share trading, as some of you may be aware, that it is very common for any trading, so sort of any purchase and sales, to be deemed capital gains and liable to be capital gains tax. This would mean that any gains, sort of proceeds minus costs, after deducting the annual exemption for the year of £12,300, would be subject to the capital gains tax rates of 10 and 20%, depending on an individual's level of income. There are very, very few circumstances, and I think the word there, exceptional circumstances, would apply, that Hmrc deemed that trading is carried out to the extent where the income received will be taxable as trading income and will be liable to income tax and national insurance on any profits made. Hmrc do look at some set points when considering if the activity amounts to a taxable trade. These are well known as the badges of trade as well, but there are four main ones which sort of they've pointed out, especially in relation to cryptocurrency, where they say they'll consider these 4 points, and if these 4 points deemed for the activity to be trading, it'll be taxable as it'll be liable to income tax and national insurance. But if not, it'll be highly likely that it will be capital and be liable to capital gains tax. Sort of going just through each of them factors in detail. So the degree of activity, if it really comes down to how many trades are being carried out in a day. If sort of you carry out maybe even 1 or 2 trades in a day, or the odd trade here and there, it's highly unlikely to be deemed a taxable trade by Hmrc. So any sales or purchases, any sales will be deemed capital gains. If it is the case where someone is making hundreds or thousands of trades sort of every day, then it's a lot more likely to be that any profits made will be liable to income tax, and it will be deemed a taxable trade for tax purposes. When looking at organisation, it comes down to what an individual does have in place to trade on. If someone is just trading on their phone, is trading on a laptop, maybe has one computer set up to trade, it's sort of, they don't have an organisation in place to be trading full time in a way. And whereas if someone has multiple computers set up with multiple screens, almost like you'd see on the movies in a way, or if an individual employs people maybe in the UK, could be abroad as well, which is not uncommon, who have setups and who spend a lot of time trading and have that organisation in place, it's a lot more likely to be deemed a taxable trade and be liable to income tax and national insurance as well. Risk comes down to sort of financial risk. The greater the financial risk, really. So if someone's investing tens of thousands, hundreds of thousands of pounds and making a number of transactions, is a lot more likely to be deemed a taxable trade rather than capital gains. And last but not least, commercialities, the ability to produce profits and in more detail, significant profits from trading cryptocurrency, which will likely be a taxable trade. I think it is, although them 4 points have been listed out there, it is important to point out that these rules are not to be looked at in isolation and should all be considered when deciding if the trading should be deemed a taxable trade or it should be a capital gain. It doesn't mean, say, if just one rule's met, that the trading will amount to a taxable trade. All of the activities have to be looked at. And it is also important to point out that it is a consideration on a case-by-case basis. It's not the case where if one individual is doing something that amounts to a taxable trade, because someone else is doing something similar, it will be a taxable trade as well. Each of these points has to be considered in detail as well for the other individual to ensure that it is being treated correctly for the tax treatment. And if it's a taxable trade, then it is subject to income tax and national insurance, but if not, then it is subject to capital gains tax. Now, because it is highly unlikely that an individual will be carrying out trading to the extent where it will be deemed a taxable trade, it is highly likely that any disposals, any sales of cryptocurrency will be deemed capital gains, so will be liable to capital gains tax. Now, it is a common misconception that a disposal only occurs where there is the sale of a cryptocurrency for cash, and either the cash is left within the exchange or is extracted from the exchange and the person receives it within their bank account. But that isn't actually the case, and there are a lot more occasions where a deemed disposal takes place for capital gains tax purposes, which would need to be reported on a self-assessment return. So a disposal is sort of anywhere where an individual loses beneficial ownership of the token at some point during the transaction. Now, this may be the sale of a cryptocurrency for cash, which would be a capital gain, the sale of one coin for a different type of coin, which is commonly missed when deeming a disposal. People seem to forget that if you dispose of one coin for another coin, it is actually disposal, and it won't just be, a standard trade in a way, and won't be subject to capital gains tax. Using cryptocurrency to pay for goods or services, that is also deemed a disposal of cryptocurrency, and a gifting of cryptocurrency to another individual as well. That again will be deemed a disposal, unless it's to a spouse or civil partner, which it won't be deemed a disposal for capital gains tax purposes. It is worth pointing out that it is only the sale of one coin for a different type of coin that is deemed a disposal. If one coin is transferred on one exchange, so for example, if Bitcoin is held on one exchange and is transferred to a different exchange, that would not be deemed a disposal for capital gains tax purposes. And because it is the same coin, and because beneficial ownership, as detailed at the bottom of the slide, is retained throughout the transaction. So you would be the owner of the Bitcoin on one exchange, and when it's transferred to the new exchange as well, you're still the owner of the Bitcoin as well. It is important to be mindful of these rules because whilst you are trading cryptocurrency, it is very common, say, to start off with Bitcoin and then exchange some of the Bitcoin for Ethereum, and then maybe exchange Ethereum for another type of coin. Whilst it can be easy to forget that the sale of the Bitcoin for the Ethereum is a disposal, so it does need to be reported, and we will go on to sort of how the gains are calculated. So very simply, if a cryptocurrency is sold for cash, it is a very simple disposal where the cash received on the sale of the cryptocurrency will be the the proceeds, and any cost associated for purchase of the cryptocurrency will be deducted, and the gain will be calculated. And sort of if any profits made, it'll be if it's in excess of the annual exemption, it'll be liable to capital gains tax. Now, you may be wondering, sort of, it's all well and good saying the sale of one coin for another will be liable to capital gains tax, but how are you supposed to calculate the sale proceeds for the purposes of calculating the capital gain? So the process for the sale of one coin for a different type of coin, the fair market value of the coin traded for the coin to be received will be the sale proceeds, and the original purchase price of the coin exchange will be the cost. Now, the open market value can be found in many exchanges, and there are a number of price charts as well online which can be used. So they have to be used, and it is worth pointing out it has to be the open market value of the coin being purchased, not the coin being sold, sort of exchange for the new coin. For paying for goods and services, the price paid for the goods will be deemed as sale proceeds, and the cost will be sort of the cost related directly to the asset. That is very similar to sale of cryptocurrency for cash. You won't need the open market value because you have the sale proceeds from the item that you've purchased in a way. And the gifting of a coin to another individual as well, besides a spouse, the deemed sale proceeds again will be the open market value of the coin at the date of gift. For any accountants or tax advisors listening, the Section 104 pooling rules also apply to cryptocurrency as they do to shares as well. So the average cost, if cryptocurrency has been purchased over a period of time and there's been separate transactions and separate dates, the Section 104 pooling rules will apply. So the average cost of the cryptocurrency will be taken when calculating the gain. And it is worth pointing out as well that the same day rules and the 30-day matching rules also apply. So if you do have any clients who do have gains who have sold cryptocurrency and purchased cryptocurrency, the same type of cryptocurrency, it is important to keep these rules in mind when calculating any taxable gains. Moving on, whilst I have discussed a lot about profits that could be made, it is also highly likely that a loss could be made on the sale of cryptocurrency if it falls in value or it becomes of negligible value, which we will go on to. So sort of any capital losses made on cryptocurrencies, so where proceeds are less than the cost purchased for, the losses can be used, there will be capital losses, and they can be reused against current year capital gains and can also be carried forward and offset against future years' capital gains as well. Now, if a token was to become worthless, a negligible value claim can also be made to claim a capital loss, and the crypto token must have been held at the time it became of negligible value. And I've included the example in there of the Terra Luna price crash. So that is very recent, as of sort of about a month ago today, actually, where the Terra Luna price was trading at over $80 on the exchange, and within 24 to 48 hours, the price crashed by over 99.9%. And the price of it now is actually trading at less than 1 cent, or 0.00072 cents to be exact. Apologies to anyone if they did hold Terra Luna during that price crash, because I'm sure it will still be a sore subject to it. So apologies to anyone listening if you did hold that coin at the time the price crashed. So if you did hold that coin or any other coins that have become of negligible value, a loss relief claim can be made to Hmrc, and the loss will be a capital loss. It can be offset against current year gains, or it can be carried forward and offset against future years' capital gains as well. No loss relief is available if token is lost. So because tokens can be generated on computer hardware as well, sort of if the computer hardware was lost or if a token was stolen, it would not be deemed a disposal of capital gains tax purposes, unfortunately. So no losses could be claimed for them. Moving on to sort of different mechanisms within crypto. So that essentially covers a lot of the capital gain side of cryptocurrency, sort of proceeds minus cost, giving you capital gains, and how gains and disposals are deemed by Hmrc. Now, there are within cryptocurrency, there are different mechanisms and sort of different niche areas, which sort of I will go through in detail. And these are just to be aware of in case you are sort of more knowledgeable on cryptocurrency and want to find out a bit more on what tax implications will be for these. So starting off with mining. Mining is sort of a method of creating coins. So it usually involves computers or computer hardware. Very commonly, you can purchase computer hardware. It does tend to be quite expensive, but they can be used to solve mathematical problems in order to generate new tokens in the blockchain. So essentially, there are mathematical problems, and once these puzzles are solved, a token can be received. So if the mathematical problems for, say, a Bitcoin is solved, and the individual who solves the puzzle will receive the Bitcoin. Now, mining can be deemed to be a trade, but again, it is very dependent on the factors listed earlier. So sort of the risk, the organization, sort of how common trades are taking place when it could be deemed a trade. But if it was deemed a trade, if someone was carrying the activity out to the extent where it is deemed a trade, any profits made from mining will be taxable as trading income, and the sale of these coins will give rise to an additional trading profit or loss. Now, if these conditions aren't met, so if the mining is not deemed a trade, if any coins are received whilst mining, the receipt of any coins will be taxable as other income. So the fair market value when you receive the coin will be taxable as other income, and any allowable expenses. So what tends to be the most common expenses: computer, electricity costs, costs for the computer hardware. Any of them costs will be deductible against the other income when calculating sort of the taxable profit. Although I had mentioned taxable profit there, it will be treated as other income, so it will be liable to the income tax rates at 20%, 40% and 45%, depending on an individual's level of income, but it will not be liable to national insurance as it will be deemed other income. And again, the sale of any tokens generated via mining will be chargeable to capital gains tax. It is always worth keeping in mind that although there might be income tax implications of receiving cryptocurrency, there will always be capital gains tax implications of selling cryptocurrency unless it is deemed to be a trade. So it is always worth being mindful of it, just in case you dispose of any cryptocurrency. Moving on to staking. So staking is very similar to, put it simply, receiving interest on sort of cash received, cash at a bank. But what is the difference with staking is it's only available on certain coins on certain platforms. Normally, if you're going to receive interest on a bank account, you can sort of deposit in many bank accounts, although the interest rates aren't great these days. You can deposit money in any bank account and you are likely to receive interest on it. Whereas with staking, there is certain coins and certain platforms that can be staked on, and not all coins can be available for staking. It is as proof of stake coins that can be staked on, but that is a whole nother area, which I don't think we will need to get into in this webinar. Any income received from staking income, it is taxable as other income rather than interest. So it will be liable to the 20%, 40% and 45% income tax rates. And unfortunately, it will not benefit from sort of the personal savings allowance or the starting rate band. So the 0% interest rate. So it will be taxable at the income tax rates. if an individual does make a business out of staking crypto assets, the income received will be taxable as trading income. Again, as I mentioned earlier with the sort of criteria to qualify as a trade and as trading income, it will be highly, highly unlikely that anyone does staking to the extent where it qualifies as a trade. So more commonly, it will be treated as other income on the self-assessment return and liable to the income tax rates, but it won't be liable to any national insurance. Moving on to forking now. Forking is very much a capital gains tax implication rather than an income tax implication. So forking occurs where there is a change or update to a specific blockchain. So sort of you have blockchains which create the cryptocurrency. Now there can be changes to the blockchain made by users, and that will create either a soft fork or a hard fork. A soft fork is a very simple update to the blockchain, but there is actually no split to the chain. So if you had, for example, Bitcoin and there was a soft fork of Bitcoin, it would still be Bitcoin going forward. There wouldn't be any updates to the chain, and no new coins would be created from the chain. Now, that differs to a hard fork where a change is made to the blockchain. So a new physical blockchain is created. So, for example, there, Bitcoin, it was, I think, back in 2017 or 2018, Bitcoin had the blockchain, but a hard fork was made to Bitcoin. So a new blockchain was created called Bitcoin Cash. Now, this is actually a separate cryptocurrency on its own, so that you would receive that asset, them tokens, and they could be traded. They could be then sold or traded for a different coin, whilst you also maintain the Bitcoin that you had previously. More recently, the Terra Luna, as I mentioned earlier, has undergone a hard fork as well. So again, that'll be, you will retain your original crypto asset, but you will also receive another crypto asset as well. Although with the Terra Luna hard fork, I don't believe the original asset will have much value, less than 1 cent, as I mentioned earlier. There will be no tax implications of a soft fork. So where there's just a simple update to the blockchain, no new coins are created, there'll be no tax implications of that. And on a hard fork as well, there will be no immediate tax payable on the coins received on a hard fork. So it won't be that the market value of the coins received will be liable to income tax. There'll be no income tax implications of any forking. The only implication which will happen is the capital gains tax implication on sale. So when calculating the base cost of the new coin received on the fork, it will be a proportion of the base cost of the original coins. So for example, if you had Bitcoin and that was forked into Bitcoin and Bitcoin Cash, the value of the Bitcoin Cash, so the cost you would allocate to that if it was ever sold, would be a proportion of the cost of Bitcoin, and they would be split depending on the open market value of the new coin at the date it was received. Moving on to airdrops. Now, airdrops are essentially free tokens which are distributed to individuals. It could be as a result of signing up for a specific airdrop. It could be as a result of holding a specific cryptocurrency. But the airdrop token will not be the same cryptocurrency as someone receives if it was because of holding a certain cryptocurrency. It will be a completely new cryptocurrency which operates independently and would be sold independently, and would be shown as being held independently as well. Now, it is very important to point out on an airdrop, there'll be income tax. Some airdrops will be liable to income tax, and receipt of some airdrops won't be liable to income tax. And it all comes down to if something is expected in return for the airdrop. So, for example, which is quite common with airdrops, if an airdrop was received by an individual, but they had to do a marketing campaign for it, so they had to sort of market it on social media, for example, then income tax would be due on the airdrop, and that would be deemed as other income. The income tax would be liable on the open market value of the airdrop when received by the individual, and that would be liable to income tax at 20, 40 or 45%. and that would not be liable to national insurance because it would be deemed other income. Now, if airdrops are received with nothing expected in return, say you signed up for an airdrop and you received the tokens, no income tax will be payable because there's actually nothing done in return for receiving the airdrop. It is income tax will only be due where sort of it's deemed a service, so it's also almost deemed a payment for services. So if an individual, like I said, if an individual advertises the airdrop or the token to get people to invest, then you could almost deem it to be the airdrop is being paid to them as a payment for their services for advertising. Whereas if nothing is done with nothing, if no advertising is done, nothing expected in return, there'll be no income tax payable on the airdrop. And again, whenever an airdrop token is sold, regardless of whether it was liable to income tax when received or if it wasn't, capital gains tax will be due on the sale, which will be the proceeds for sale minus the cost of receiving the airdrop, which will be sort of the open market value when received. Now, it is becoming more common now that contracts or part of contracts are being paid via cryptocurrency. It is being seen like a large number of high-profile sports contracts in America and in Europe, and now in the UK too, are being paid partly by cryptocurrency. And we do envisage that this will become more popular, especially with people that are entitled to bonuses, performance-related bonuses as well. People might put it in the contracts where if you receive set targets, then you will receive, say, 1 Ethereum or part of a Bitcoin or maybe another coin as well. So it is important to point out that where cryptocurrency is received as payment for part of an employment contract, it will be subject to income tax and national insurance contributions on the value of the cryptocurrency when paid to the individual. Unfortunately, it won't be exempt from tax. It will be liable to income tax and national insurance, class 1 primary national insurance, and also class 1 secondary national insurance as well for the employer. Income tax and national insurance will be due on the best estimate of the value of the asset at the date provided to the employee. So again, like I said earlier, a lot of it is taken on open market value. So the open market value of the coin given to the employee would be taken at that date, and that will be liable to income tax and national insurance. And it is, again, worth pointing out that any subsequent disposal of the token would be subject to capital gains tax for the employee, and it wouldn't be sort of exempt from tax because it has been liable to income tax and national insurance. Now, I guess because we've been through the tax implications of cryptocurrency, the niche areas of cryptocurrency, you will want to know what Hmrc are doing to get their slice of the pie to ensure that any tax is being collected on cryptocurrency correctly, and any any income or any capital gains is being treated correctly on a self-assessment return. Hmrc did issue an initial nudge letter on the 20th of October 2021 to various individuals who may currently hold or have either held cryptocurrency in the past. Now, this letter was not a direct inquiry letter. It is a one-to-many letter, just a more of a reminder to remind individuals, if you do hold cryptocurrency, it is taxable in the UK, and you may need to speak to an advisor to get advice on if you have disposed of any, what tax you may have to pay and what tax you may have to report as well. It is an important point, something to point out, that not to worry if you have received one of these letters. It is not something to have sleepless nights about. Hmrc won't be opening up an inquiry into you. It is more of a reminder that cryptocurrency is taxable and it does need to be reported. So if you have received a letter, or say if you have done many trades in the previous years which have never been reported, I think it would be a good time to speak to an advisor and get some advice on if there are any tax implications of sale and how these can be reported to Hmrc. It is also worth pointing out that Hmrc have issued a notice to Coinbee, who are the biggest exchange, within the UK anyway, to provide information of users' accounts who've received currency payments or proceeds from the sale of cryptocurrency of more than £5,000 during the 2019 and 2020 tax years. And it is also envisaged that they've requested customer data from other cryptocurrency exchanges as well. So it could be that a lot more letters are seen. For advisors, it could be that a lot more of your clients receive a letter. The initial nudge letter, although it was issued, it says it was issued to a set number of individuals who have held or currently hold cryptocurrency. There was no actual limit. So just speaking from experience, a client only held sort of £750 in their account, hadn't invested yet, and they got a one-to-many letter, whereas other individuals who have done trading and do hold a lot more cryptocurrency didn't receive a letter. So again, it is Hmrc, I assume, are working through it and trying to get letters out to everyone, but it will be a slow process. And again, it's worth mentioning not to worry if you have received a letter. Speak to your advisor, or sort of if you don't have any activity, don't worry about it. If you do have activity which needs to be reported from previous years, speak to an advisor, and we can sort of work out how to report this to Hmrc. Lastly, just some other tax implications of cryptocurrency from an inheritance tax perspective. It is deemed property for inheritance tax, so it will make up part of an individual's estate. I don't want to go into too much detail with inheritance tax, as this has been covered in a previous webinar, but it will make up a property, and the location of the assets for a non-UK domiciled individual is a grey area, but it is typically where they are located where the individual is resident. So if someone was UK resident, then the location of the cryptocurrency will be deemed UK. Whereas if they're resident in another country, the cryptocurrency would sort of be located in the other country as well. The transfer of exchange tokens are likely to be chargeable to stamp duty, but if consideration for a land transaction was paid in cryptocurrency, this would come in under the definition of money's worth, so it would still be chargeable to stamp duty, land tax. So it is unlikely that a payment would be made for land via cryptocurrency, but just in case it is, it would still be liable to stamp duty, land tax at the standard rates. It is worth pointing out again on the residency point that the residency of the cryptocurrency will follow the individual, and it is so if an individual is UK resident but the exchange you trade on is an American exchange, unfortunately them cryptocurrencies still need to be reported to Hmrc and still make up as part of your estate because they are deemed to be located in the UK. That is sort of covers all the tax implications of cryptocurrency, and I will now hand over to Tony, who will take you through Coinbee.
Wonderful. Thank you very much, Mohammed. I just want to start off by sort of just testing that I can be heard loud and clearly. And if there's any issues, just please post it in the chat here. So I'll proceed on from Mohammed's eloquent presentation. And first thing is to realize is, yes, crypto is taxable. Unfortunately, there is still a myth out there that perhaps crypto is not taxable, it evades a tax net, and that is certainly not the case. Here in the UK and pretty much across the globe, there's a very, very few sort of countries where crypto is not subject to any kind of tax. So given that, it's a case of, well, if you are an investor or a trader or you're participating in activities, then the case here is, well, how do you practically deal with this? And I like to sort of use an analogy here where if you're faced with a derelict house, for example, and you're being asked, there you go and knock that house down in the quickest possible time, and you've been armed with a hammer, for example, a manual hammer. I mean, you'll get the job done, but it's going to take you a long time. It's going to be perhaps very, very painful indeed. And no doubt, it may be questionable whether you can get the job done properly with such limited tools. So really, it's a case of, well, how do we help you power up? How do we turbocharge you, give you the right tools and facilities in order to sort of get through what is potentially a minefield and complete your taxes fairly and truly, so you confidently can submit to Hmrc in your self-assessment returns. And that's where Coinbee comes into play. So I'm going to now switch over to a demo screen. So I'm going to give a very, very quick fire demo of Coinbee and how it can help. So do bear with me whilst I just bring the right screen up on the webinar. Okay, so once again, hopefully that can be seen. So first and foremost, Coinbee was incepted in about 2018, 2019. So we've been around for almost 3 years. And one of the principal objectives of Coinbee is to sort of bring all your crypto assets and trades all into one place. So there's going to be a lot of you out there who are probably trading on various different exchanges. You're using a Coinbase, maybe you got a bit of Binance there, maybe you have a Trust wallet, which is a non-custodial wallet. You're participating in some decentralized finance activities. Maybe you've even got a sort of cold wallet, hard wallet, like a Trezor, which is a USB stick. And a little bit of internal data analytics that we managed to sort of get from Coinbee is the average investor in the UK is using anywhere between 3 to 5 wallets, blockchains, or exchanges to actually trade and participate in their crypto activity. So getting that all together is the first challenge. And if you can imagine going into each and every exchange and trying to download a CSV document or a PDF file to give you the right information, maybe a transaction list, whatever it is, making sense of that is going to be very, very challenging indeed. You're going to get a various spectrum or degree of inconsistency and a mishmash of data, which is very difficult to bring together. So the first thing Coinbee would do is bring that all together. And what you want to be doing here, you can see the dashboard that you'll be faced with once you've signed up to Coinbee. And incidentally, Coinbee is free to use. As a portfolio tracker, it is free to use. So you can go in, here is the web page. And again, hopefully you can see this all, it's coinbee.io. And you can sign up for free and use it for free up to a certain stage. Now, when I'm in Coinbee, what I need to do first and foremost is just connect all my wallets, exchanges, and if it's directly off the chain, then I need to put my sort of Ethereum address or my Polygon address. So that is what I'm going to do here. I got Binance, I've got Coinbase, I've got Trezor linked, and just to add a wallet or exchange, it's very, very simple. I'm going to press this button, and let's say I've got a Kraken exchange here. I'm going to go into Kraken. Here's my wallet name because it's a custodial wallet, because this is a centralized exchange. And I want to set up what's called an auto sync. And it's very, very simple. You just go and get the API key and the API secret from Kraken, your Kraken account. You can start importing from the beginning. Now, this is a really important point that even Mohammed alluded to, the fact that there may be quite a few of you or some people out there that, whether by design or whatever's happened, have not managed to report your crypto for many years. Well, then, there could be a retrospective reporting requirement here. You might want to bring everything up to date. So Coinbee will go and grab everything you've done from that particular exchange right from the beginning. Press the button, you can secure the import. Once you've made that connection, it's there. It's very, very simple. So I'll go into Coinbase just as an example. All I'm going to do is, once it's all connected, there's a big green button. And sorry about this, I can't see it here because I'm on a demo account, but there's a big green button that you'll press, which is just a sync now button. And you synchronize your trades from your exchanges or different wallets, and it pulls it all into Coinbee. Once that happens, what you'll see here is a lovely dashboard, which will give you a total aggregated view. And obviously that's what Hmrc need. They need you to report their aggregated view. And it has happened, regrettably, that quite a few people have reported siloed data simply because they were just getting it straight off a single exchange and completely forgetting about the fact that I had crypto in other wallets or traded through other wallets. So it'll give you a breakdown of what your total value is. Not great here for me at the moment. I'm pretty down, but it is my demo account. And what the cost basis was, the original cost that you paid for the aggregated tokens, and any what's called unrealized gains or losses that you may be sitting on. And these are unrealized, will be paper gains or losses. They're not actually crystallized as such. And if they're just paper gains and losses, you don't need to really report to Hmrc until you've actually triggered a disposal event. So in which case, you've got a breakdown then of all the assets that you're holding, including any fiat currency as well, ranging from ETH to BNB. I've got here, it shows me all my market values. It shows me the costs that are paid according to the Section 104 pooling rules, as Mohammed mentioned. Then I move on, and once I'm all connected, I want to download a tax report. So let's say for the 21-22 tax year, I can download a tax report that I can then use to file for my self-assessment return. I'm going to select, sorry, 22-23 in this case, because it's got some numbers here that can be reported. So it shows me a lovely little summary. It shows me, well, what kind of disposal capital gains or P&L I've got. They are crystallized gains that I must report. Well, obviously, in this case, it's underneath the 12,300 threshold. So I may get away with not having to report. In fact, technically, I don't have to report it. But obviously, if that figure is over and above, I would be reporting it. It will tell you any income that I've generated through airdrops, mining, rewards through staking, for example, and any gifts, donations, and lost coins. So it summarizes it quite nicely there. Incidentally, also what Coinbee would do is it's got an inbuilt validation tool as well. So if there are certain transactions that don't quite seem right, or seem perhaps they have missing cost bases, or the market prices may not seem entirely correct, it will actually flag it and say, look, you need to review these particular transactions, go and take a look as an internal validation. So once I get to the end of the year, and sorry, just taking one step back again here, you can download or you can look at this on a frequent basis. And this is where you really want to work with your accountant, most likely, is when you've got these kind of real-time numbers, you want to be assessing how your investments are doing, how they're actually performing, whether it's a case you can talk to your accountant as to, if there's certain instances you may want to cash out if you're not quite making the money, or if you're in a loss situation. Certainly, as alluded to with the Terra situation, it wasn't particularly great, in which case, you'll have the real-time information. And then what I'll do is I'll just go down to one of the reports here, and there's various reports that you can actually download, the main one being the complete tax report. And I've downloaded one earlier. And if I look at the tax report, and this is what it gives me. It'll give me a timestamp, the period in which it relates to. So this is the current tax year, which we're in at the moment. And it will actually then display and report the numbers, number of disposals, actual disposals. So whether they are selling my crypto for fiat, whether I've done a crypto to crypto exchange, whether I've actually gifted my crypto, anything that constitutes a disposal according to the Hmrc guidelines. What the proceeds were, that's a sale value, the acquisition costs, any profits and losses broken up in the net gain. So these numbers you can practically lift up and put into your self-assessment return. There's another gains section here. Another gains really is just all about if you're a day trader doing margins, CFDs, perhaps futures trading, you have an option to report it separately here if you so wish. If not, they can be integrated into the capital gains summary. And then we move down to an income summary where I've got an airdrop there on £9.04 on an airdrop at the fair market value upon the receipt of that airdrop. There's a bit of other income in there as well. So any forks mining, rewards, loan interest, and other kind of activities, perhaps a bit more advanced activities, which could be subject to income tax summary, it will be reported in the income summary. And any related expenses that may even go with that, indeed. There's an asset summary and then end of year balances and capital gains transactions. So it gives you the granular detail in the report as well. And that you will lead as an audit trail, A, for your own information, and B, as an audit trail if Hmrc decide they want to do a compliance check, for example. So with regards to Coinbee, you can either use this individually, you can sign up individually and use this and invite your accountant into your particular account, or you can actually sign up through your accountant. Either or, the choice is yours. And in terms of where do you actually pay for the software, well, you only pay for it if you want to download a tax report. That's the only point that you need to pay for it. Otherwise, all the functionality prior to that is from a individual retailer point of view, completely free to use. So hopefully that's given you a quick whistle-stop tour of Coinbee. Again, you can speak to MHA if you want to sort of, work with them in terms of this piece of software. And again, I just come back to the fact that, this is a turbocharge-o-matic drill, which is going to really help you get through this quickly and swiftly in a very automated way. But there are certain areas, even, with our software, where the judgment calls will need to be made. So I always recommend, if you can work with an accountant, that would be perhaps the most optimal way of dealing with your crypto taxes, obviously depending on the complexity of your affairs. And just going back to that screen, here's our website link, which is coinbee.io. So hopefully that's been very useful.
Thank you, Tony. Thanks, Mohammed. We have, as ever, slightly run over in time. We've got very few minutes left in our allotted hour. So perhaps I could ask Steve if there are any questions that have come through that we might have a chance to answer in the last.
Yes, there are a number actually. Some on sort of similar topics. The first question, really, I suppose, in general terms, is some people consider the revenues manual and guidance fairly brief, and they've asked if there are any other authoritative sources about the tax treatment of cryptocurrencies.
Yeah, so with regards to the tax treatment of crypto, obviously the forefront authority at the moment is the tax agent, which here in the UK is the tax agency, which is obviously Hmrc, but they do draw sort of, it's all drawn upon current case law that's in existence at the point of publication for any sort of, particular piece of the guidance. Any other authorities, obviously the FCA, which is the regulatory body, and if there's any sort of regulatory legislation there that lends itself to crypto, is always considered. Then you've also got tax agencies around the world as well. So in North America, the US, Canada, where I do believe, in my personal opinion, there is an influence from one to another. Certainly when Hmrc came out with their DeFi guidance, I know the US were looking at that quite clearly as to how to shape their particular policy. So I think they're the kind of main authorities in my view. The rest is, they will always seek industry guidance as well, because a lot of us in industry are at the forefront of this as to how potentially they can make crypto taxes perhaps more simple and more conducive, obviously, within the parameters which they can work.
Thank you. And there's a few specific ones, but I'm not sure they'll be of that general interest. But someone's asked, what's the proposed treatment by Hmrc of stable coins pegged to fiat and CBDCs?
Yeah, I can sort of give you a little bit of a steer there. I mean, if we look at stable coins, CBDCs, obviously CBDCs being government-backed stable coins, as things currently stand, if they were to launch a stable coin like a Bitcoin, for example, then I still believe it will still come in the scope of the same kind of taxation as you would an ordinary buying a Bitcoin or Ethereum or altcoin. However, in saying that, obviously it could become legal tender. In fact, it probably will become legal tender. And if it's legal tender, then we're talking about currency here. And if we're talking about currency, then really technically, it should not be subject to tax upon a disposal. Or they could bring in something called like a threshold, like the US are doing, who announced, one of the senators announced 2 days ago, that they want to introduce regulation where certain transactions up to a certain threshold, I think it was about $200, if I'm not mistaken, is not subject to taxation. So that's the views. I don't think they're particularly, they've been 100% prescriptive on this yet, because obviously it's still in consultation, it's still in development, but I think they're the kind of thoughts I have on that.
Thanks, Tony. Let's do one more, Steve. I think we probably ought to bring it to an end.
Right, yes, well, there are quite a few. I've got one which I think it's slightly difficult to interpret the question, but I think the question is, do the bread and breakfasting rules apply to cryptocurrencies?
Yes, they will apply to cryptocurrencies. Sort of if you did sell a cryptocurrency and then were to purchase a cryptocurrency in the next 30 days, it would be deemed a sale of the cryptocurrency purchased in the next 30 days, so capital gain would still arise.
Thank you.
Thanks, Mohammed. And thank you, everyone, again. Thanks to all those listening. We do try and end these webinars pretty much within the hour. We've occasionally gone slightly over, as we have today, but I know people have other things to do. We will try and get back to questioners if we haven't been able to cover it today separately. And obviously, feel free to get in touch if you do have further questions to us, or if you wish, directly to Tony at Coinbee. It just falls to me to say thank you to the presenters, thanks to everyone for attending, and we'll see you at our next webinar in due course. Thank you very much.